Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, Michael Becker.
Hey, Paul.
Michael, what did you think about Dr. Dotzer's talk the other night?
It was great as always. So we had, I think, over 500 people what actually showed up, which was a little bit more than what we thought would actually attend. So that was great. We're fortunate we were able to scramble and add a few more chairs in the room at the last minute and make it happen. As always, he delivered a great, high energy, very entertaining, very funny. And, the message he delivered was, kind of clear sailing or smooth sailings ahead, I think was the title of his speech. So he was very bullish about the economy and having multiple years of runway still left on it. And the tax reform that happened that he didn't think was going to happen that actually happened really kind of extended the cycle. That was his basic high-level takeaway.
Yeah, he was very thumbs up on the economy, thumbs up about what's going on with business, very thumbs up with commercial real estate. And I think with a room full of investors that invest in apartments, invest in commercial real estate, I think the takeaway was that we're doing okay. We're doing all right, so just keep on investing in commercial real estate.
Yeah, the one stat that was a little shocking to me, he showed all the jobs that were created this century since 2000 and on, and Texas led the nation, which isn't surprising, the most jobs, but it was something like 2.2 million new jobs have been created in Texas since the year 2000, which was just a staggering number of jobs, and it outpaced California by I think 600,000-700,000 jobs. So that was an eye-popping chart that I saw from Dr. Dotzer.
Yeah. More jobs mean more opportunities for landlords to fill apartment buildings with good tenants that pay rent on time. So let's just keep going with that. What else is going on in the Old Capital world?
I think we are trying to get in one more speaker series before the summer. So we're targeting something in May. So stay tuned for that. We're putting that together as we speak. So we'll hopefully have that announced on the next podcast that comes out. And we'll certainly have it on the oldcapitalpodcast.com website. And then, of course, the Old Capital Conference is coming up September 13th. And Paul, you announced it the other night with Dotzauer. You want to announce who the new keynote speaker is?
So in keeping the theme of tremendous keynotes, and we talked about this, the overall theme for Old Capital is get in the game. Get in the game. And so we're having the event, as we've mentioned, at AT&T Stadium. Yeah, the AT&T Stadium. We will be in the stadium. We expect a big crowd in the stadium. But our keynote speaker under that same theme of get in the game is somebody is pretty damn dynamic, I would imagine. He is 2 Super Bowl champions under his belt, a Hall of Fame player, and just an absolute Dallas legend in not only sports, but also in real estate. So our keynote speaker for 2018 is going to be Roger Staubach. Roger Staubach will be our keynote speaker. Talk a little bit about getting in the game. He, on the off seasons when he was throwing the ball for the Dallas Cowboys, he was in the real estate business, and he sold his company, Staubach Group, to JLL a number of years ago, made hundreds of millions of dollars. So he knows something about real estate, knows something about being in the game. So we're excited to have Roger Staubach as our keynote speaker. Make sure you go to the Old Capital Podcast to get your tickets to the September 13th conference. That's an all-day conference, and we want to see you there. We'll be talking not only real estate in Dallas and Texas, but we'll also talk a little bit about what's going on nationally, not only in California or Colorado or Denver or Chicago or Florida. We'll cover a lot of the different sections of things you should be knowing about in apartment real estate. So we're excited to announce that. Mike, anything else?
You know who we're excited for? The person we're going to have on the podcast right now. So maybe we should kick it off.
So this guy, we've known him for a long period of time. Last time he was on a podcast with us was probably, 2 years ago, I would think. And we're excited to have J.C. Castillo in the podcast. J.C., who owns hundreds and hundreds of apartment units in the Dallas-Fort Worth area, is a very knowledgeable guy. He brings the information down to the bottom level. So he is an owner-operator of apartment buildings, and so we're excited to have JC in the podcast. So JC, thanks for being in the podcast.
Thanks for having me on, guys. It's good to talk to you, Paul and Mike.
So tell us a little bit about your background. What do you do?
Yeah, so I'm a guy that lives in San Jose in the Silicon Valley, so I guess I would be your typical Silicon Valley story, engineering guy in the semiconductor business, which is kind of the old fogey side of the technology business for folks that live out in the Silicon Valley, but I've been in that business for about the last 20 years. But for about the last maybe 12 or so years, I've had a private equity real estate investment company that does value-add apartment deals. And we've built a pretty sizable business here in the Dallas-Fort Worth market. As you guys know, we've all been buddies for probably almost as long as I've been in this business out here.
So you live in San Jose, but you invest in Dallas. Why is that?
Well, it's really simple. I mean, it comes down to cash flow, right? I mean, you get into the apartment business not just to generate equity through value add or forced appreciation, but we get into the apartment business because we want to generate cash flow. And many, many, many years ago, I've always been into real estate when I was buying single-family homes in San Jose and making money out there. I wanted to buy apartments, so did all my research and tried to buy an apartment complex in San Jose, and I figured out that I'd be negative cash flow for the first 2-3 years, and then maybe I could break even. And then maybe after another couple years, I could, make a couple bucks. And I figured, well, if I'm going to do that, I might as well keep buying homes because homes are in a better location. And if you're buying for the value of the dirt, then buy a home, not an apartment complex. So I really started to look outside of California at that point. And I did a lot of analysis. I mean, that's in my nature as an engineer. And Dallas, Fort Worth, and Texas in general was really, back then in 2006 or so when I was looking, all signs were pointing me to this being a phenomenal market, not just for the first couple years when I went there, but a market where I could go and set up shop for 10, 20, possibly 30 years, and the market would just keep growing. And, we're sitting here 12 years later, and I don't think that I've been that wrong about this market. It's been a fantastic market for us.
So you've been buying real estate in the Dallas-Fort Worth market for about 12 years. How did you do in the downturn?
Yeah, I think that's a good question. And actually these days with a lot of the market success, and most people know that it's been a really good rental market, I think that first of all, were you even in the downturn? Have you gone through a cycle? A lot of people can't really say that. I bet you Roger Staubach's been through several cycles, ups and downs. But we bought our first 3 deals right before the economy tanked. In fact, back then, actually, Michael Becker actually did all my loans for me with Wells Fargo. And what I figured out on the back end of the recession was that we did really well during the recession. And the reason we did well, and I looked back and really reflected on it and looked at to why, is because there's a few things that I've always done from day one. And the first thing I always did was bought on real numbers. For example, I asked people for bank statements for the last 12 months. So I don't just go off of the income statement. I actually go and do a delta between month over month and T12 and make sure that as much money is coming into the bank statements is more or less within 5% range of what they've got on their P&L. If there's a big delta, that's going to be an issue. So buy on real numbers. And the second thing is that I'd get out and walk the deals, walk the neighborhoods, and be aware of putting your renter's hat on and saying, would I feel safe? Would I want to live here? Assuming that we fix up the property, you can't change a neighborhood. If it's a really dangerous neighborhood, if you don't feel safe at night as an investor, well, guess what? Your families that are going to live there are probably not going to feel safe either. So when the recession happened, what really happened was wasn't necessarily that people moved out of Dallas-Fort Worth or any other big metro. There was a fundamental compaction of the family unit. So the way that I explain it is, mom was working at Walmart for 30 years and she had a good job. She wasn't going anywhere, but her 26-year-old son was working at Craig & Auto Parts and her 22-year-old daughter was working at Target. Well, they both got laid off during the recession. So what did they do? They moved back in with mom. Well, so you have a situation where there's still the same number of people in the metro, but you got 2 units that went vacant and 1 unit that's still occupied now with 3 residents instead of 1, mom and the daughter and the son. Well, at that point, the consumer has choices because the law of supply and demand dictates that if you've got a lot of options, you're going to go to the place that gives you the best value for your dollar spent. So if you're a landlord operator or an owner and you've got a good property that's in a great location and you take care of your repairs when they're needed, guess what? During the downturn, you're going to stay pretty good. You might even be able to raise rents. But if you're a guy that's not taking care of your property, if you bought in a real mediocre location, guess what? Those are the guys that really went out of business during the downturn. And these sorts of things come in cycles, and they can happen again.
So through that cycle, when you raised capital, how did you start off? Like, what was like your typical investor when you started out? And then is that any different than what your kind of typical investor is today, 12 or so years later?
What it was back then, it was basically me with my money. And it was a couple of partners that were real estate guys in San Jose that knew the business. And so we together took our money and we came out here and we bought some deals. And then from there, as things started doing well, I ended up having a lot of technology buddies that we'd be talking over the water cooler at lunch. And they would basically ask me what I'm doing for investing, and I would tell them what I'm doing, and they would say what they're doing. And a lot of them started asking me questions about how they could come in on deals with me. And that's kind of how the private equity company that we have was born. It was really born out of a desire for people that were in my technology space to have a certain percentage of their investable dollars go into long-term real estate holds. And I happened to be the guy that had built a business, an out-of-state business, that was able to find these deals, these great, phenomenal cash flowing deals out in Texas. And so I was basically the bridge. And what I am today, and I still am, is I'm the bridge between the California technology capital and the deals out here in Texas. And so really it started off as me doing deals. And as I got good and made money, I have a lot of technology friends over the years, and they've all become my partners as well in the real estate piece.
As you go through this, how many properties have you bought and how many units?
We've bought and sold about 1,000 doors here in Texas over the years. And out of those, right now today, I think we have about 650 or 700 units.
So I kind of described JC. He doesn't live here, but he's sort of like an unofficial local at this point because he's been here so long. How's kind of your relationship with the brokers community, how that's kind of evolved over the last, say, 12 years, and how's the market different from today than like 12 years ago, and the way you interact with the brokers community? Because I know a lot of people, that's a big mental challenge, is how do I get that first deal done? How do I overcome that? So maybe kind of describe how you've evolved over those 1,000 plus units.
Yeah, for sure. I mean, when I first came out here, I really didn't have any sort of a reputation, be it good or be it bad. I had no reputation. And the other negative that I had against me was I was a California guy. So in any market, when you want to come into a market, if you're not a local guy, people are going to want to know who you are, what your intentions are. And with California comes the stigma of these guys really don't know the market. All they want to do is come in and buy a bunch of deals. They have no idea what the fundamentals are here. So a lot of it is really being humble and focusing on building deep relationships with key people. I think the mistake that a lot of people make when they try to come out here and do deals for the first time is that they try to call every single realtor that they can get their hands on. And basically they figure it's a numbers game. And to some extent that's true. But all of us that have been in this business long enough know that for whatever reason, you tend to connect and develop relationships with special brokers or special realtors. And the deeper that you can make those relationships, the better you're going to be. Because at the end of the day, people prefer to do business with their friends, all things being equal. So how do you become not only business partners with these guys, how do you become friends? How do you weave in the fabric of who you are and mate it with the fabric of what they're about? And it takes more than business meetings. It takes, knowing their family. It takes, going out on trips. It takes for them to maybe even stay at your house or you to stay at their house. I mean, relationships are everything in every business, but I kind of feel like in this real estate thing, relationships have been the difference for me in terms of getting deals done. And then just being on the outside and thinking, well, what happened? I don't even know, right? So I think for me, relationships is the most important thing. And the second thing that I would say is you really have to be a person of your word. If you're going to say something, you have to do it. You have to become known as a guy that's either a closer or a guy that is not a closer. And once you build that reputation, there's no turning back. You become branded, and either you are a guy that's a closer or you're not, or you're a guy that does business the right way or you're not, or you're a guy that's a one and done. You don't want to be a one and done, a guy that comes in, does one deal, and the realtor says, gee whiz, that JC guy, I don't think I ever want to do another deal with him because I brought him into this guy that I had a relationship with on the sell side. I gave him the opportunity to buy the deal, and he completely pissed off the seller, and he just made my life a nightmare. Thanks, but no thanks. JC's never going to do a deal with me because you didn't just screw that relationship up. he's going to talk to 4 or 5 of the other guys out here in this market, and they all know each other. So that's the way to do deals out here.
So before we get kind of into the couple case studies we want to talk about with you, thinking back, so if I'm a first timer, especially if I'm out of state, who were the brokers that you kind of targeted out? Did you go for the top flight brokers that are selling the most deals, or how did you decide which brokers you're going to seek out to start forming those relationships you described?
I think when you first get into the business and you're sort of on the bottom ladder of sort of the buying pool, you really have to try to do your best to link up with people that are at the same level as you, kind of, so if you're just getting started off as an apartment guy and you want to buy your first deal, guess what? You're not going to go call the top dog at ARA and say, hey, I'm here, let's do a deal. Well, guess what? The guy's been doing deals with 5 other guys for 10 years, and you are never going to get a call back from that guy. In fact, you're wasting your time, if I could be honest. What you have to try to do if you're just getting started out is find that diamond in the rough, that young realtor that's also hungry just like you are and that wants to make his name on the broker side. And you've got to go to him and build your relationship with him. And if you pick your right horse and you guys come up together, guess what? In 5 to 10 years, he's going to be that top dog at Marcus & Millichap. And when he becomes that top dog, he's going to remember the guy that came up with him, and it's going to be you. And so I think that the mistake that a lot of guys make is they get enamored with the big names, but they don't realize that in order to get with the big names, you've got to be a big name yourself. Well, the guys that are going to make a name for themselves on the younger ladder are the same guys you need to go focus, because those are the guys going to bring you to the next level. That's the way I would partner.
I couldn't agree more. That's exactly what I did when we started out. And you start with the younger guys, then as I think I'll echo everything JC said, that you start out, you get a deal done, you're person of your word, you do what you say what you do, and you got to be a closer, because nothing else matters. So if you dunk a deal or two, it's going to be hard to overcome that stigma in the marketplace. And he says it's even a big market like Dallas-Fort Worth with 7.4 million people and 750,000 apartment units. There's 5 shops, 6 shops that control 85% of the market. And then within those shops, there's 5, 6 people within each group that really run the deal. So it's a very tight-knit community.
So Mike, you own a couple apartment buildings.
A few.
Let's say somebody brought you an LOI that you accepted, and all of a sudden they didn't follow through with anything they said they were going to do. How much of a kiss of death is that?
Well, yeah, that's happened before.
Yes, that's why I bring it up.
And there's a certain gentleman, I won't say his name on this podcast, from Los Angeles who works for a large brokerage shop out of Los Angeles, a nationwide one, that was trying to buy some properties here locally, and I certainly did my best to try to make sure everyone in town knew what he did to me. And I don't think he's bought another deal in town since that. So, he's not only did it to me, he did it to a couple other people, and he's out of business in our market, and we're, the 3rd, 4th largest market in the country. So it doesn't take very long. You do it once or twice. And
so some people do it the right way, and some people do it the wrong way. JC absolutely does it the right way. And we are very happy with that. Would you describe yourself as a longer-term investor, and really what does longer-term mean?
Yeah, I mean, that's a great question. I think every sponsor, every value-add company, private equity company that does deals has to have an identity. They have to be known for something, right? And what we've sort of become known for, and I think the identity is not just something that you come up with and make up. It's something that sounds cool. I mean, the identity of Multifamily Property Group, our company, our private equity company, is really the identity of who I am and who I identify with as partners. And that is that we look at these deals as retirement packages, as mailbox money that we generate over many, many years. And so we're not really necessarily the type of equity company that wants to be in the flipping business. Not to say that we haven't sold deals in 2-3 years and done well, but in general, we're more of the long-term guys. So the private equity partners and the investors that we work well with are guys that are a little bit more long-term focused. And, we're looking for 10 to 12-year holds. And we're looking focused primarily on yields. And we do see equity upside significant in our deals, but we also are very cognizant of the fact that sometimes equity plays are not only a result of the value that we bring, but also a reflection of the market. Obviously, the market in the last 4 or 5 years has been really great, so it's hidden a lot of mistakes. But we believe, and I personally believe, that heading into this next 2, 3, 4, 5 years, that you absolutely need to be more focused on the yield play and how you generate operational efficiencies, because you may have to keep deals for a lot longer than 3 years. And so it becomes more of a process of how do you squeeze more lime out of the same lemon to sort of keep making your dollars here in this market.
So what I think we really want to spend the next good chunk of the podcast on is maybe a couple of case studies and some deals you've done. But before we do that, one of the things that us at Old Capital are going to support you on is you're starting a new investor network kind of meetup or a group based out of the Silicon Valley out of Northern California. So maybe kind of before we get into some case studies, maybe kind of talk about that and describe what you're putting together.
Yeah, well, thanks a lot for letting me plug that for sure, Mike. I think it's a really big deal. I think it goes back to, if you really think about the genesis of sort of where I came from and sort of what I happened to take advantage of in this Texas market, it basically comes down to California capital that was able to get out there and see a different market that was in a growing state, a growth mode, and really take that California capital and really accelerate the returns on that investment, as opposed to keeping it in California where it's really tough to make apartment numbers work. And so in doing that, in fact, I'm pretty excited to be partnering with Paul Peebles of Old Capital and also with Brad Sumrock on the education piece. And I'm proud to partner with those guys, because what we're going to do is we're going to bring the Apartment Investor Network to the West Coast. And the mission of the Apartment Investor Network is going to be to basically get California people plugged into these really amazing out-of-state multifamily markets and teach them and show them the networks and the tools necessary to come out here and actually do these deals and take advantage of the market that we have out here. So that's pretty exciting to me, because I don't think at the level that we want to do this, that anybody's actually bringing that 100% multifamily focus to the West Coast specifically for these types of out-of-state opportunities. And I'm pretty excited about it. So we're going to kick off our first Apartment Investor Network meeting on May 2nd. It's going to be in San Jose, California, in the Northern California area. And if you are interested in signing up and registering for our first free inaugural meeting, you can go to my website, multifamgroup.com. That's multifamgroup.com. Go to the events section, and from there you can get information and sign up for this fantastic event. We've got David Kahn of CoStar coming out, who is an expert in the Texas and Dallas-Fort Worth market, that's going to be talking about the state of the market here in Texas. And that's going to be a phenomenally great and educational event for people that are looking to learn about markets like the Texas market.
It's great, and I'm sure Mr. Paul Peoples is going to be there too, right? You can meet him in person.
I'm pretty sure Paul's going to be there.
I will be there. I mean, it's always fun to have a bunch of these California investors, as we say, live in California but invest in Texas, and an opportunity to not jump on an airplane and see some of our people from the speaker series actually are going to fly out to California. So let's talk a little bit about the case studies. You have purchased a couple properties recently, and I want to kind of focus in on two properties that you guys bought. One is called Crestwood Apartments. The other one is called Westwind. And let's kind of kick it off with Crestwood. Was that a value-added or a stabilized property?
Yeah, I'd say that was definitely a value-add property.
Okay, so how competitive was the marketing on this deal?
It was a pretty competitive landscape for the deal. We kind of had the advantage because, as we talked about earlier, I had a relationship with the broker. We'd done deals together in the past, and he basically called me up and said, look, we've got this deal, and this is probably the best dirt I've ever sold. But the property's a little bit older, and it needs some work, but you can't beat this location, and I think the property could be something if you put some money into it. So I know enough about this guy to know that if he tells me that, then it's probably some truth to it. So we jumped on it right away. We underwrote the deal, got out here, took a look at the deal, and what he said was exactly true. This is a special deal. It's a pretty unique deal, and there was a lot of hair on it. So I think one of the things that we had to get over was, how are we going to create this value? It's not maybe a traditional sort of value add deal that we like to do down the fairway, but the location and where it was located, this was something that we had to go after.
So let's kind of talk a little bit about this property. Again, it's Crestwood Apartments. How many units was it?
So this is a 114-unit deal.
What year was it built?
Yeah, so that's the interesting thing. This deal is 40% of the units were built in 1980, and 60% of the units were built in 1940. So it's really got this unique mix. It looks more like a colonial-style building, and it's got a unique mix of old and new, and sort of how you marry the two together was really the secret in this deal.
Do you have a website if somebody wanted to kind of take a look at this property to give it?
Yeah, we do, absolutely. So we're an owner-operator. So if you go to Luminera Properties, that's spelled Luminera, properties.com, you can basically go and you can see our portfolio. You can click on Crestwood. That'll take you to the Crestwood Place website. You can also just Google Crestwood Place Apartments in Fort Worth, and we've got a dedicated website where you can see pictures of it.
So describe the neighborhood, because you said this is irreplaceable dirt. I mean, it truly is. Very mature trees. Neighborhood is typical average homes in that neighborhood would be?
Oh, we're talking, several hundred thousands to multi-million-dollar homes that are sitting basically adjacent to the property.
Yeah, this property is in Fort Worth, so the property would be in the neighborhood of, say, $750,000 to $1.5 million. If this property was in Northern California, it would be worth, homes would be $3.5 to $5 million.
That's correct.
And so you have an apartment building that kind of stands by itself. It was built, it said, in the early 40s. Just absolutely gorgeous. Again, tall, mature trees. Almost looks like a park setting. You bought it how long ago? Was it 2 years ago?
Yeah, so we closed that deal, I think, in November of 2016.
And there was no
right around the election. Mike remembers well. We talked stories about how we had swings in the 10-year Treasury that kind of nearly made us all have heart attacks.
Yeah, I wouldn't so much say election results. It was a dark time with the 10-year Treasury spiking about 70 basis points.
That's right.
Seemingly overnight. But it was a challenge.
Did you buy it as a syndication, or did you have the money yourself?
Yeah, so these days, we're a private equity shop, so we syndicate our deals. I still put my own money into my deals, but majority of the capital is coming from private equity out in the Silicon Valley.
How many investors would you say were in that deal?
In that particular deal, I would say we had right around probably 30 investors.
So when you say that the 10-year Treasury rose, why is that so important? What type of a loan did you get?
We got a Fannie Mae loan, and we had a 12-year term on it. And, with the rates swinging so wildly, what it did was it dropped our loan to value. So we couldn't meet the DSCR, or the lender couldn't. They had to drop our dollars that they were going to lend to us. So that means we had to go out and raise at the last minute an extra, X number of hundreds of thousands of dollars.
Mike, what does that mean in English?
It means it's painful. That you got to, like JC said, you have, could be multiple $100,000s of additional capital you have to bring in. So it kind of raises the amount of equity you have in the deal, and kind of generally hurts the returns from a cash flow standpoint, because you have less debt, you have more equity, and kind of messes your calculations up a little bit.
So when you bought the property, where were rents?
Rents were probably, jog my memory here, but I would say that they were probably in like the $725 range for the one-bedroom units that were the majority of the older units that we wanted to renovate.
So $725 was kind of the average of rents for that property. Again, this is a nice property in a nice area. You had a game plan coming into some rehab. So let's kind of talk a little bit about the rehab on the property. So how much money do you think you had in the rehab budget of that property?
I want to say we put about $900,000 to $1 million into the deal, somewhere around there. And a majority of that money we put into replacing windows and replacing all of this property had window units, 8 window AC units, and they were just a sight for sore eyes, and they didn't really work well. And so we put in brand new mini split systems, AC systems, in all of the 60% of the units, which were the 1940s construction units.
What was the occupancy at the time that you guys bought the property?
The time we bought the property, if you could believe it, the property was 100% occupied. And actually, it had been 100% occupied for quite some time.
So you go in and you rehab a property. Do you have to take the occupancy down to do some of the work?
Well, I don't think we ever want to take the occupancy down intentionally. I guess you could in some cases when you need to clear people out. But, we were hoping that we could keep the property relatively full and do the renovations. But with this particular deal, the renovations that we wanted to do were a little bit more, what I would say, disruptive to the actual residents living there. Imagine you're living in a unit and somebody's coming in to replace an entire AC system with all the plumbing, and not only that, but it's a mini split system, so a lot of the guts of the system actually have to be exposed to the unit itself. So it's a very invasive process, and so we actually lost a lot of residents just because they didn't want to deal with construction people coming in, multiple times to make these repairs and these improvements to the units. So, we did get hit. I think we went down to about probably 85% occupancy.
Well, that's not bad.
Which isn't bad, but it's not good either. We didn't really want to be below 90. And so that was definitely a challenge that we faced.
On the front side of a transaction, you put together a rehab budget. You get all your contractors on the property and kind of figure out what it's going to cost to kind of, physically change the property itself. You guys wanted to put the split HVAC system in there. It's not an exact science in putting together a rehab budget, but what were some of the things that you found that you needed more money to be put at? So tell us a little bit about where the rest of the money went to.
Yeah, I think that, again, I go back to the mini split systems. It's something so simple as, look, not only do we need to put the mini split systems in, but we always do asbestos testing. Mm-hmm. So we found out that we had to abate because we found some small traces of asbestos in the drywall. So that means you got to go and you've got to pay a professional to go and tape off the area, bubble up the area, make it safe so that when you're doing that work, you get no dust, no exposure to any sorts of those things. Wham, that's a huge expense, right? And sort of finding out about that and having to do it adds a layer of expense and complexity that actually disrupts the resident's lifestyle even more. Because now imagine, not only are you doing the mini split system, but before that, you've got to go, have them move their living room around, put plastic around an area, tape it off, make it secure, make it dust proof, and then you go in and do the system. So now, there's just a whole nother element that is a disruption to the residents, right?
Mike, has that happened to you where you bought a property, you go in and say, I think I need more money?
Yeah, but unfortunately, I never had to do any sort of major asbestos abatement because we've never taken on as big a project as what it sounds like JC was doing here. But yeah, that's certainly something that I've learned. One of the key principles of the business that we try to take into it is you're always taking more money than you think you need because you never know what's going to come up. There's always something that happens in these deals. So fortunately, it seems like JC had enough money to be able to make it work, but even though I'm sure it was a little hair-raising along the way.
Because a lot of people think they can do this rehab and any additional expenses can be taken out of cash flow of the property, and that is absolutely incorrect.
Yeah, and especially if your occupancy goes down, then the cash flow is not so strong.
No.
We're in the lower troughs of occupancy.
Yeah, and he wanted a long-term maturity on this loan, so he didn't do a short-term maturity, so he's able to ride out any problems in the future too. So that was good. So taxes on that property, have they increased on that deal?
Property taxes definitely went up on the property. In fact, we got assessed for higher than the purchase price.
So what did you do on that
property? Well, we've been partnered with Cantrell McCulloch for years and years and years, and we work exclusively with them to, as a tax consultant, to get our property taxes put back in line to where they should be. And so we worked with real closely with CJ Arnold, who I've been working with many years at Cantrell, and he was able to get in there, and we were able to do some analysis, and we were able to get the property way back down into where it should be, which was a huge windfall for us. And so from a property tax perspective, if you've got the right people on your team, I think that you can navigate because the counties will assess you at pretty significant and aggressive rates these days.
That's good. Let's talk a little bit about Westwood. Or anything more to add to the...
Well, the silver lining to Crestwood is that we turned the corner in the last couple of months, and we've just really seen that deal. Those units that I told you were renting for $700 range, now we're renting them for $925, $950, and they're renting all day.
Wow.
Because they just look like a different product. So our numbers are now starting to really, really come around, and I'm actually pretty happy. Sometimes with these deals, you really have to stick to your guns. If you're been experienced in this business a long time, and you have enough experience to know that if you stay the course and really focus on your strategy, sometimes you don't know when it's going to turn a corner. Sometimes it takes quicker, sometimes longer. But if you stay the course and really focus on giving the value to the units and to the residents, at some point that switch comes on, and it's really so fun to see those numbers shoot up because you go, wow, all that work we put in this deal, we're finally seeing it turn the corner just like we thought it could, and that's a really good feeling.
Wow, that's great. Mike?
Yeah, no, that's awesome. That it's such a great location and pocket over there and such a unique vintage. One of the things that was interesting, my little tie to the deal was back in my previous life before the bank, before Wells Fargo, we actually had a loan on that property. And plan was a developer bought it. He ended up de-leasing the property in 2008 or something like that. And all of a sudden, everything hit the fan. And he quickly re-leased it back up because he was going to scrape the entire place and develop some really high-end residential lots and, multi-million-dollar homes on the property kind of pre-recession. So that tells you the type of location that asset's located in, the neighborhood is located in.
I agree. For that deal, for sure, in 10, 12 years from now, you may see us looking into some other interesting opportunities with that sort of dirt that we've got out there.
Let's talk about Westwind over in Irving. Value added or a stabilized property?
Definitely a value add. Definitely a value add property.
This was an off-market deal. How did you get the deal?
Again, I go back to the relationship piece, right? There's a broker that's here in Dallas-Fort Worth who I kind of came up with him. We kind of came up around the same time. Mm-hmm. He was a rising star at his company, and I had never done a deal. And, I treated him right, and he took care of me. And now he's a pretty established player out here. And that deal came to me through this particular relationship. And like you said, it never hit the market. He had a relationship with the seller who happened to be needing to get rid of the property fast because he was moving a bunch of money over to a new construction deal that he was working on. And so he was able to hook us up together. I'm a closer. This guy needed to sell fast and make sure he closed. And so the numbers, we underwrote him. We got an offer on the table as quick as we could. And even in this hot market, the deal made sense for us and it made sense for the seller.
So you talked about why he sold. Was there anything unique with the deal as far as like kind of his physical condition? How rough was, you said it's definitely value add. Kind of how rough was the property and what were some things that you were needing to do on the asset physically?
Yeah, everybody runs their deals differently. I would say that this person was the type of owner that ran it very skinny. And so he didn't like to spend as much money on the repairs to the property. And in return, he kept the rents probably way too low, definitely below market for the residents. But the residents had to put up with a lot of things that people that were paying market would never put up with. So that type of an owner is typically an ideal owner for a value add guy to buy from, because what we go in and we do is we basically fix all the deferred maintenance and we put an upgrade package together, and we start to definitely work on running expenses the way they should be done, so we don't cut corners on repairs. And so then when you have that type of an opportunity, you get it's like a double bonus, because if you run it properly, you can bring everybody up to market to begin with. But then you put the value add piece, and now you can sort of bring in a kicker. And so if you bring the kicker in, now it's like an accelerator. So for a deal like that, that's like you hunt for those deals and you find them. You just count your lucky stars.
How do you do a value added play while you live in Northern California? Who's overseeing the general contractor and the rehabber and all these people?
Well, I've been out here for a long time, so I've been fortunate to develop a really great team here locally. So I'm an owner-operator, so like I said, we also do management, but we have a team of about 25 people that work for us out here in the DFW Metro. So in particular, in my core team, I've got a vice president of acquisitions and capital funding, and then I've got a vice president of repositions. And so my VP of repositions is the guy that's in charge of these major projects that we undertake in terms of coordinating with the contractors and getting all the work done.
How would you describe your typical tenant? What do they do?
We're in the workforce housing business, so a lot of these guys are in the construction business, for example, or in the, say, blue-collar business of, janitorial services at a big company, or they may be working at an industrial center, moving boxes or some sort of things like that. We cater to the workforce housing component, and then we also cater to some gray-collar folks that maybe aren't necessarily engineers at TI, but maybe they're floor managers under the operations facility.
So you can take this property, would you say when you bought it as a C property and kind of make it into a B minus?
I would say that we're bringing it to a B minus. I would say that it was definitely a C class asset prior to that, and bringing it into a B minus with the type of renovations that we're doing to the property.
And then why didn't Fannie Mae loan work for you at the beginning?
That's a good question. So, we had to get bridge debt on this deal because the deal wasn't cash flowing enough to get the proper leverage on the deal to make the numbers work. And so, if you go to Fannie Mae and you're going to go and get a deal done for a deal like this, and they look and they run the numbers and they say, look, the best we can do on this deal is to give you 55 or 60% leverage on this deal. Well, we don't feel like we want to come in with 45% down payment to do a deal. And so what we do is we go to one of our bridge partners and we basically do a bridge loan, a short-term loan, which is going to be a little bit more aggressive on the terms and get us up to the leverage that we need. And we bridge out on the back end once we get the financials up to where they should be.
So how long have you owned this property now?
We bought that property in March of last year, and on the 13th of March of last year, and we actually put our application in Fannie Mae to refinance with good old Fritz at Doherty on March 13th of this year.
Right, on the anniversary. That's great.
So on the anniversary, we're out. We had a 1% prepay on the bridge debt. But we're happy to pay the 1% prepay because we can more than make up for some things with the amount of money we can pull out on the refi. Plus, we've got the green reduction on the rate. So there's a lot of benefits to us pulling the trigger right now.
And so what are you looking like? So how much of the capital are you going to be able to get out? Are you going to still have any money left in? Or
so we're not really going to pull too much out. I believe we're going to pull out right around $500,000 or $600,000. And that's going to be enough to basically take care of all of the water conservation efforts. It's going to take care of a little bit more of the finish outs of the rehab. And then it's really going to take care of a lot of the interior upgrades that we're doing to the property. So we're going to keep on using that money to go do all the improvements to the interiors of the units.
That's great. Yeah, doing that, in 14 months or so from time you bought it to getting into permanent debt, that's great. So, Paul, I don't know if you have anything else. It's been great to see JC. I've known JC a long time. As he alluded to, we did a bunch of deals together back in my former life. He's kind of grown up from doing these little small deals in Garland, and now he's doing some bigger and nicer deals, and has been real successful. And actually, JC bought a property off of me a few years ago, and now he's going to market. It's going to make a bunch of money on it, so that's been great to see that from afar. If there's any other kind of words of wisdom or any sort of this kind of like principle things that you've learned through this last 12 years, I thought your words about starting with kind of like the junior broker and kind of betting on them that they grow up in the business, making sure you kind of do what you say you're going to do. Is there any other sort of like business principles that you've kind of learned through this that you maybe can impart upon someone who's aspiring in this business? Yeah,
definitely. I mean, I think the one thing I want to end it with is, especially now more than ever, I mean, we've just had a phenomenal run. And, remember I told you that I started this business on a down cycle, got in bright-eyed and bushy-tailed, and, the Great Recession hit. And I saw a lot of bad things happen to a lot of good people, and some bad people too. I think that having a perspective of what can go wrong and looking out for the downside and protecting the downside is almost as important these days as the upside, because nobody knows, nobody can predict the future. And I do think it's a little bit of smooth sailing, as you guys would say, based on a number of things, but you really have to mitigate on the downside too. And so the way that you're leveraging up, and the way that you're putting your debt structures in place, and the way that you are building your team to be more of a permanent type business as opposed to fly by night, let's flip some deals and make some quick cash. If you don't prepare yourself for the downturn or the downside, and you don't protect your investors' capital and do what you can to make sure that you preserve the capital at all costs, even if they don't make a dime, most investors will tell you, look, I can live not making any returns, just don't lose my money, don't lose my capital. Because you lose my capital, there goes everything. So my advice is to really focus these days not only on how you're buying value add deals and how you make the money, but also put a strategy together on how you mitigate for the downturn if there is one, or put a strategy together on how you protect your capital in case the market takes a dip, and think about what can go wrong just as much as you think about what could go right.
So I have just my 2 cents on that, because I definitely agree with that. As an old banker said to me a long time ago, 99 attaboys do not equal 1 oh shit. So lower leverage, longer maturity. I was just having this conversation with an investor last night after the Dotzer meeting, is that, these markets can change in a heartbeat. We saw what happened, like in your case with Crestwood, where interest rates went up right after the election, and you had to ask for more money from your investors. That we weren't expecting that prior to the election. We didn't think that was going to happen. But the markets can turn off. So always make sure you have a protected downside so you do not have the 1 oh shit. Mike?
Definitely true. Yeah. So I think JC does business the right way, and he certainly is. Like I said, he doesn't live here, but he's considered local by the brokerage community, and that's something that a lot of people that come in from out of state, a lot of California people try to come to Texas and buy in Texas, and they have challenges, the same challenges he had when he came here, and he did it the right way and was able to kind of overcome it. So I think, especially if you guys are based in the Northern California area or anywhere really in California, it's an easy flight to get up to San Jose. I would certainly encourage you guys to come out and see Paul and JC on was May 2nd. Maybe tell again a little quick about what they're gonna hear again, and kind of the best way to find out information about your upcoming event.
Yeah, for sure. So we're starting up a group called the Apartment Investor Network. It's a West Coast-based networking group, and we're having our inaugural meeting in San Jose on May the 2nd. The evening of May the 2nd. If you'd like to get more information, you can go to our website, multifamgroup.com. You can just go to the events page and you can read all about it. You can sign up for the event. Our guest speaker will be featured is going to be a gentleman by the name of David Kahn. He's from CoStar, and he is an expert in the Texas market with a lot of data behind what's going to happen to the apartment market here in Texas and how many legs it's got left here in 2018 and beyond. And so if you're looking to do out-of-state stuff in Texas, this is the type of guy that you absolutely should not miss, because he's giving you real data that's going to help you make decisions on whether or not Texas is going to be a great state to invest in for the next couple years here.
Some great information. That was J.C. Castillo. J.C. Castillo, we do appreciate you being the podcast. Thanks for all your time, and look forward to seeing you on May 2nd up in San Jose. Michael Becker, always a pleasure.
Thank you, Paul.
I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.